Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. This is Bill Bullington here every Saturday morning from 11 to 2. I also operate Bullington Capital Management. If you'd like to learn more about my firm, you can go to the website, bullingtoncapital.com. If you hear anything that you would like more information on during this radio show, you can always reach out. 330-664-0700 is the phone number, and I will try to get back to you as quickly as I possibly can. I was just looking at all the major indexes around the world, and very interesting as to what's happened in the past, going back to 2021, actually. That's a pretty good time period, 4 years, and a lot of the major indexes are not, they're barely profitable, and some of them are down, which is kind of wild. I don't think that hasn't happened a lot of times over my career, but the ones that have done the best, if you took the top 50 stocks out of the S&P 500, or the Russell 1000, returns go up significantly because those were the stocks that have performed the best over that time period. And quite frankly, that would get you in trouble as an advisor if you limited your investments to that. If you didn't have clients who were pretty sophisticated and understood that they were narrowing down the number of stocks they're investing in an effort to increase their returns, which also increases the risk. So a portfolio that doesn't have as much risk in concentration, one that's concentrated on, say, the top 40 or 50 stocks, it paid off to take that extra risk. And if you were doing the right thing, for most people, especially when you're reading what the SEC guidelines are, FINRA, that kind of stuff, doing the more traditional method has not really worked nearly as well. So, and the reason I'm bringing this up is we are obligated to follow certain rules, and we can you can go around the rules if clients sophisticated and signs a document that says, yes, I know I'm taking more risk and I'm willing to take more risk in an effort to increase my return. But anyway, I just thought it was interesting. I've been reading I always read a lot, but it's just mind-boggling how the majority of the returns fall to a super small number of stocks. And there is a way to capitalize on that, by the way. And I'd actually been using it for quite a while, and I stopped using it because the transactions that are involved, if it's a taxable account, you have to rebalance those portfolios very frequently. If it's a taxable account, you're going to get a ton of transaction because you're rebalancing a 40 stock portfolio every month, and you're going to get minuscule transactions in a lot of the stocks. Some of them will get replaced completely, and actually about a third. So in an effort to reach those gains, you've got to put up with a lot, and that is a lot. The vast majority of people just don't really want to do that. And there are a couple of ETFs that are extremely close to that, which make that much more feasible for somebody in a taxable account. If it's an IRA, you don't care. Um, so anyway, and the reason I'm spending so much time on this is that I rebuilt this model that I'd run for a very long time and did very well. Um, and I rolled it back out. So if you've got an IRA and you want to be a little bit more on the aggressive side, then this is the way to go. And incidentally, I did not invent this. This was done years and years ago. Fidelity was one of the first fund families to experiment with computerized trading models in their mutual fund complex there. And so they started doing it back in the late 60s. And they did it in quite a few funds, but inevitably, I mean, then along came Janus, by the way, 20th century. If you're old enough, you probably recognize those names. And you also recognize the fact that at some point in time, they got too big. What do I mean by that? Well, they were managing so much money because that strategy was a really good one, was very productive at that time. And it attracted an awful lot of assets. And the bigger the assets got, the more difficult it was to buy and sell the underlying stocks without affecting their share prices. And that's part of the what you pay for success is that the more money you manage, the more money you make. But also, the harder it gets to give the performance that you were getting when you were smaller. So it's I don't think I'm not young enough to have the problem of reaching billions of dollars in assets under management to really have to worry about that too much. And I did. I brought this back out and I started into it myself. I wouldn't suggest more than probably 25% maximum that you would put of your whole portfolio into something like that. And that way, as it's fluctuating, it's not having as big of an impact on your portfolio as if you were 100%. You're only going to get 25% of the fluctuation. I think that's probably a pretty good number for most households. Some people could do more. Mine's locked in. I think it's actually less than 20%, just slightly less than 20%. And so anyway, if you'd like more information on that or just like to talk about it, if you'd like to get some idea of what the current holdings are, you'll probably recognize a really good percentage of them. And I think it's a good thing. And I think it goes in really well with, the annuities that I talk about quite often. Why would I say that? Those two are the opposite ends of the spectrum. Yes, they are. And if you are at an age, let's say you're above the age of 50, and you don't cherish the idea of your stocks going down and taking 10 years to recover, I'm not saying that's going to happen, but it's happened before. In fact, I'm looking at the Russell 1000 Index Fund, and you go to March of 2000. It was a March of 2013 before the price got back up above where it was in 2000. That's a long time. The S&P 500 like that. S&P 500. If I go back March of 2000, It didn't stay above it until 2013. And like I said, that's a long time. That is totally irresponsible for somebody to talk about. And I read a lot about this. And I read a lot about how the S&P 500 can't be beat. Well, you know what? It might just beat you into submission and run you out of money during retirement if you don't have it allocated correctly, and especially if you had all of your money in there and then thought you were going to take income from it, you're pretty much guaranteed to run out. I mean, the first time you went down 50% and you're taking money out, well, let's just say you started taking out 4%. Well, 4% of something that's down by 50, so let's say it goes from 100 down to 50%. Okay. You were taking 4% out over 3 years. You were 12% down and more than that because it was dropping and you were spending more money. So now you're down more than 50%. You're not making it back. It's not. You're going to run out of money before you retire. And that's why when somebody gets closer to retirement, you need to start backing that off. And realistically, try to take a look at how much of a decline you'd really be willing to put up with. And mine's 35%, which is a lot. Yeah, but that allows me to put about roughly 70% of my money in stocks and stock funds, and the other 30% I just have in short-term bonds, short-term. And the vast majority of them are in a bond ETF. I don't even have to worry about picking the bond. Some I do, but it's a relatively small percentage. Anyway, so I just, in a nutshell, gave you the methodology that you probably should be using to manage your money before and during retirement. How much of a risk taker are you? You got to be honest. That's the hardest part of this whole industry. Everybody wants returns when they're good. And I put together I put together the portfolio I was talking about earlier. Top 40 stocks, done very well just in a few months that I've had it. And it's actually done well for decades. I'm going back to the 60s. And, but it is all over the place. I mean, it just in the, I think that 8 to 10 weeks that I've had it, it was up 10%, down 10%, and now it's back to up 11%. That's a lot. And it's enough to scare a lot of people away from it. And you know what? If that scares you away, you shouldn't be doing it because you cannot avoid that. That's part of the cost of the higher return, is you have to put up with the fluctuation that comes with that. And I can't believe after the last 30 years that I've been doing this that I'm still having these conversations. But you know what happened is, like me, this is the first year that I just turned eligible for Social Security. I just turned. I'm not taking it, by the way, but it's it's a long time, and a lot of people that get to this age never have the time to kind of study and break down the kind of stuff I'm talking about. So I get it. It's hard, and they don't teach this anywhere that I've been to. Maybe at a graduate school on portfolio management, you might have classes in it if you went to Columbia or Harvard. But and if you even the CFA courses, these are courses where certified financial analysts are supposed to know everything there is to know about financial markets and just be a really highly trained expert. Well, some of the math that they're using there, I just don't get this. I cannot believe and that they haven't figured this out yet. And the reality is they have figured it out. They just don't want to talk about it because they defended a model that's broken, that some big firm paid $3 billion for 20 years ago because it was supposed to contain all the secrets. And I'm out here exposing the secrets. It's a good thing this is a small radio station and I'm a small firm, because otherwise there'd be some major firms that packing it in right now and going out of business. But anyway, so that's the thing with stocks. Stocks are going to be extremely volatile. They've always been volatile. I think it's a little easier now. I thought that one of the reasons I left to start my own practice is that there are funds that are doing the exact same thing that I would do in the portfolios that I'm running. There are very few, by the way. I think I only counted 4 out of the thousands of funds that are out there that are coming really close to what I was doing. And the reason that I left the brokerage community to start my own firm is because what I've been doing wasn't really there. And the reality is, incidentally, that a lot of the funds didn't come around as nearly as quickly as I thought they would. And so I was ready to start using them a long time ago, and they weren't there. So now it's still volatile. You just have to know that. But if you're doing the right thing, sooner or later, it has a tendency to work out really well. At least it has in the past. Can't imagine that not doing very well in the future. So look at, I know if you don't have a ton of time or you don't want to put it any time into learning all this stuff, well, that's one of the reasons that I have a job. That's one of the reasons that we still have car mechanics, because you can get a manual that'll show you everything there is to know about cars too. But anyway, I've only got a few seconds. I have to take a real quick commercial break. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. Feel free to give us a call, 330-664-0700. That's my office number. And I'm going to be right back after these commercial messages.
Anytime a heart turns from darkness to light, anytime temptation comes and someone stands to fight, anytime somebody lives to serve and not be served, I know God is on the move.
Mike Gallagher here. Join me, Larry Elder, Joe Piscopo, Jennifer Horn, and special guests for the Patriots Alaska Cruise. Enjoy terrific conversations on the ship and connect with fellow Patriots. Space is very limited, so book your cabin today. Go to travelwithsalem.com.
Bob France here. Boy, what is the most important part of your home? I would argue the two most important parts of your home are its foundation and its roof. It's what protects the rest of the house from everything. Well, it's time to make sure that we are not going to have leaks. And one thing you're going to want to do is have it inspected and make sure that it's tip-top by calling Sky Roofing. Sky Roofing is a local company that has been serving homeowners in Northeast Ohio and business owners too for 25 years. Happy anniversary, Sky Roofing, by the way. These are great people. And these are people who really, truly put America first and their customers first. So if you've got cracked shingles causing leaks in the spring and summer showers, any damage that has been done by heavy winds or any of the stuff that happened back in the wintertime, you're going to want to call 440-349-6750. Because guess what? Repairing a roof is better than replacing a roof. It's a lot less expensive. You got to find out and see what needs you might have in order to make sure that it is tip-top. Call 440-349-6750. This is Sky Roofing. This is roofing done right. Get online. Learn more at skyroofinginc.com, skyroofinginc.com.
Attention WHK listeners. Cleveland Right to Life's weekly broadcast has a new time. Make sure to tune in Saturdays at 8 a.m. to stay informed about the ongoing fight to protect all innocent life. For more information about the organization, visit clevelandrighttolife.org.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh, my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program after 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owners sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO, Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org. Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit joycefactorydirect.com.
Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. And if you have any questions, you'd like to call me in the office, my number is 330-664-0700. I have a weekly newsletter that we put out. It's digital. And I select the articles or approve them in each week. And I thought that this was a really nice article that just went out this past week. And I thought I would just kind of read this one because I think it's very pertinent to the times. In fact, most of the resources I have to pick the articles from are places like Forbes magazine, Business Insider. There's the Wall Street Journal, Money. There's, I don't know how many thousands there are. There actually, it's definitely over 1,000. But anyway, and kind of gets inundated. So every week I have these bots out there that are searching and are bringing back articles that I then approve as to whether or not I want to send them out to clients. And I like to go through myself and kind of try to stay on top of that, what they're saying, what I'm saying. So anyway, this article came from Forbes magazine. When I say what I'm saying, I'm getting my permission to have these articles included in my email. That's how I'm saying it. I think this is a good article, and I think it might help people. So anyway, this one was the key to staying positive in a negative world. And boy, that's really, really difficult to do sometimes. And so I read this article and thought that's a pretty good one. I think some people will find help in that. Anyway, without further ado, the article starts off, even a glance at the headlines these days will give you an eyeful of negativity. The U.S. economy contracted in the first quarter for the first time in 3 years, triggering concerns about rising unemployment and fears of recession. By the way, I learned right away, 3 years in stock market years is nothing. That's still short term. Okay, I would point that out. Anyway, inflation, which had been expected to decline, is rising again. Tariffs and trade wars, particularly with China, continue to cause disruptions globally. Business leaders across multiple industries are expressing concerns about decreasing revenue and shrinking profitability as they face the fallout of the trade war. For example, General Motors announced that tariffs are increasing its cost by as much as $5 billion, prompting the company to cut its profit forecast for 2025. The Footwear Distributors and Retailers of America, which include Nike, Adidas, and other major brands, is petitioning the Trump administration for an exemption to what it called the existential threat of reciprocal tariffs on their products. Retailers looking ahead to the holiday season later this year are worried about the impact of tariffs and whether they can afford to stock their shelves. In the face of such pessimism, it's time for some realistic optimism. By the way, all of that stuff that I just read, that entire last paragraph, they are sensationalizing that for maximum reaction. That's one of the reasons that I'm not super fond. When I'm reading this kind of stuff, I like to read it fast and keep that in the back of your mind. Their job is to get your attention. So they'll accentuate the negative because people they'll slow down to look at negative things and read them much more carefully than they will positive ones. And I think that's one of the reasons that a show like mine is important, because the bottom line is, at some point in time, stock market's going to move higher. Not if it moves higher, not when it moves higher. It's going to move higher. We just don't know when. And that's the bottom line. I'll get back to that maybe later on in today's show, but I'd like to finish up this article where the guy goes on to say, in the face of such pessimism, it's time for some realistic optimism. Note the word realistic there. I'm not talking about anyone ignoring the economic data or adopting a Pollyanna attitude, which I've been accused of more than once. And by the way, the people that accused me of this 10 years ago, how you like me now? I'm just kidding. The market's up a lot, isn't it? Didn't I say that? And you accused me of being a Pollyanna? I remember that. So, and you know what? Some people are just not happy unless they're miserable, by the way. And I've run into a lot of those. And realistically, even being down the middle, stocks do better than bonds and other fixed income investments over time. Why? There's a reason for that. Because they're going to the manufacturer is going to raise prices so that they can earn a profit margin. The average margin on the S&P 500, depending on the companies, typically between 10 and 15%. Some of them have much higher than that. Some of them have much lower than that. But that, as an average, is somewhere between 10 and 15%. And guess what? They're going to try to make that. If their costs go up, they're going to raise their prices. If the cost of the components go up on a container of Tide, Procter & Gamble is going to raise the prices to offset that cost increase that they've had. And yes, we're going to complain about it, but we're still going to wash our clothes. The bottom line. That's how that works. Sorry if you don't like it that way, but that's the reality. Anyway, yeah, as the former chair and CEO of Baxter International, a $12 billion global healthcare company, and having weathered numerous economic storms in the past, I can attest to the power of a positive attitude. It's the number one defense against becoming overwhelmed by the unknown and paralyzed by fear. Amen to that. Optimism that is grounded in realism supports resilience, encourages solutions, and lowers worry, fear, anxiety, pressure, and stress. Studies also show that optimism has health benefits, which is good news for business leaders in high-pressure jobs. So you should really take a look at that. Just Google it. Look at optimism and how it supports resilience economically. You can Google that statement, and you will get a lot of articles just like this. And it's easy to get down. I mean, it's super easy, especially when you're going through a period where the trend is down. Remember, that trend is going to change. The trend's not going to stay going down forever. It's going to go back up. And I bet my life on it. And I have bet my financial life on it. Because I got an enormous amount of my money in stocks and stock funds. In fact, there are so many options today too. That's another thing that's different than it was 20 years ago. You got a lot more options in fun than we ever had. I mean, it was mind-boggling. Anyway, the article goes on to say, here are 5 ways to stay positive in an increasingly negative world. What goes up must come down, and vice versa. This is Economics 101 and the business cycle of expansion, peak contraction, trough. I'm sorry. The business cycle of expansion, peak, contraction, and trough. We see the same up and down pattern in our own lives. No one's life follows a straight path upward to bigger and better things. As simplistic as this may sound, an attitude of this too shall pass reminds us that current circumstances are not permanent. Things will change again. This realization is both liberating and empowering. It helps us maintain a positive attitude while responding to changes in the short term and planning for the long term. Amen, brother. And so when you're feeling bad, I always like to go back and look at charts of the market in different areas of the market, like technology industry or technology sector, or look at even, I was doing research here lately on utilities and the utility sector. That's a project that's still under construction, but I did find that I hadn't looked very closely at utility ETFs that are out there, and there are a couple. I'm still looking into and building models, testing the various components on those ETFs, just so I can give you a better report down the road at some point in time. Anyway, the 5 ways of staying positive. What goes up, just remember that. Expansion, peak, contraction, trough. Then it starts all over again. Knowing what to do. In 40 years of self-reflection, constantly reminding myself that I will do good. Reminding myself of what I will do in both good times and bad times. And this is one of the areas this past correction, for some reason, it starts to hit people. And at some point in time, and I always marveled at that. Like, why was this correction so much more important to the people that are having problems with it now than any of the other corrections that we came through? And I'm sure it's just a state of mind that something's happening in outside of their financial life. But sometimes I wonder, because I'll talk to somebody and their situation, the only thing that's changed about their situation is that their stocks are lower than they were 6 months ago. And I always have to go back and say, okay, how many times have we seen this before? How did we get through this before? And but like I said, every time seems a little bit different, and it is a little bit different. They're not big changes. You'll never be able to see the peak. You're not going to know when it bottoms. There are some indicators that you can help use to rebalance your portfolio. The best one I know of is going every other year, not even every year. I've seen people saying, well, you should be doing that every month. No, you shouldn't. You get too much activity, and you're going to end up hurting yourself the same way you would if you had too little activity. But about every other year is actually when I did all the back testing that I did, which was thousands and thousands of models. Especially since I've only been doing this for 30 years. The reality is, if you go in every once in a while, once every other year, it actually came back. The best in testing was if you rebalance your portfolio once every other year, you got the highest returns by doing that. Now, that could be luck. And the returns were within 1% of doing it every year or every 2 years. And oftentimes, you're better off not rebalancing the portfolio, because I'll tell you what happens. These stocks end up continuing to grow, and they grow faster They increase in value faster than the fixed income does. So if you were really wanting to just set it and forget it, there's actually some benefit to that. The negative to that is that it'll be a little bit more volatile because you're not taking money out of the stock market and putting it over into your fixed investment. So, but when I look at it, unless you're above the age of 70 and you got less than 30% of your money in fixed income, less than 30%, I wouldn't worry about it. I really wouldn't worry about it. And if you want me to take a look at your stuff and go through the numbers for you, that's what we're here for. And that's why people have financial advisors. And say, can you take a look at this? And knowing what I know about my clients, and that's part of the conversation. How sure are you of yourself? How much really, in some cases, you need every dime you can get. So taking a risk like that wouldn't make sense. But for the vast majority of people, I'm not so sure you should be doing anything other than rebalancing the portfolios every other year. It's mind-boggling how much better that did than trying to do it, every quarter. That's ridiculous. I've seen that, and that's a really tough thing to do. If you could rebalance everything every quarter, which is incredibly difficult, then yeah, but you're still going to get a ton of volatility. And your 1099 is going to be 50 or 60 pages. They do give a summary page. Most of the brokerage firms will give you a summary page, but it's very, very difficult. I think you're just bringing on a whole lot more work onto yourself. And even that 40 stock portfolio that I run through Goldman Sachs. And if you're a client and you want to see it, call me. We've just gotten it up and running. Barely. I mean, I was the first one in it. Was a couple months ago. It's actually been up 10%, down 10%. Now it's back to up 10% again. So again, it's very volatile. I wouldn't do it if I didn't think that the returns were going to be worth it. But anyway, I'm going to take a real quick commercial break. This is Bill Bullington. I'm right here on 1420 every Saturday morning from 11 to noon, and I will be back right after these messages.
I woke up with a broken heart in my chest. I couldn't sleep, couldn't get no rest. Weighed down by the heaviness of life.
Okay, friends, let's talk about something important, your health, and in this case, your sensory health, and specifically your hearing. Hey, it's Bob France for the Beltone Hearing Care Centers in Willoughby. Many people have no idea that they're losing their hearing until someone tells them they're tired of having to repeat themselves, or someone who asks, why is the TV or radio up so high? Sometimes it happens without knowing it, and that's why. When you do have an idea that maybe it's happening to you, you want to find out ASAP. And you can do that for free by calling 1-800-354-HERE. That's right, you can get a free screening and consultation by calling only 1-800-354-HEAR and talking to the second-generation, family-owned local Beltone Hearing Center in Willoughby. Listen, hearing difficulties are a reality for many people, and untreated hearing loss creates depression and anxiety for millions. You don't have to live like that. Get a free screening and find out if Beltone hearing aids are right for you. Completely free at 1-800-354-HEAR. Make that call today.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
I am surrounded on every side, can't see the light of day, but I am persuaded.
Well, welcome back. Yeah, I was talking in so many circles that I get so excited about all that stuff. It's after all these years, it still slightly changes, just enough to stay interesting. I really like that quite a bit, quite frankly. And but it's also one of the reasons, like, when you are considering a portion of the money that you want to go into fixed income, next week I'm going to go through that strategy that I've been using my entire career. That the biggest financial security suppliers for services began using a couple of years ago. They copied my risk tolerance question after years of driving everybody crazy with these nutty, 5 pages, 50 questions, and I'm just like, nah, it's not that hard. The hard part is deciding what kind of risk taker you are. That's hard. Mine is, I'm willing to be down 40%. Okay? So I'm going to go ahead and just explain this to you. I'm willing to be down 40%. Why? Because I have a lot of confidence in the market. If I was down 40%, it wouldn't affect my lifestyle. Not everybody can say that, I know, but you got to come up with your own number, and that's the number you really need to focus on and think about. How much of a decline are you really willing to withstand? And understanding that the higher the decline level that you could tolerate, the higher the projected returns should be, because you could put more of your money in stocks. Like my favorite strategy has been down more than 50%, more than once the last 20 years. It's also got the highest return. So I look at that and I go, how much should I put in there? And what is that going to do to my entire portfolio if I put the money in there? And that's how I made the decision. And so if you said, look, I really like this 40 stock strategy, or I like the growth-oriented ETFs, which, by the way, I've been I won't have time to explain all of this week, but I'll pick it back up next week. So I've been comparing the ETF models that I built myself to some ETF models that I've seen, and some market cap weighted models that I've been using. I'm just kind of comparing them right now and seeing which ones they are doing better. But anyway, the bottom line is you've got a lot of choices out there. Knowing how much risk that you can handle is key. And understand, if you don't think you can withstand a lot of risk, you're probably not going to make a lot of money. And it's unfortunate, but that's just the way it is. And I would much rather you find out from me before you started to invest what the risk levels were, than find out the hard way. That's by being invested and then watching it go down. So you want to be prepared. And that question that I've always built my entire practice around was, how much of a decline are you willing to accept in your portfolio in an effort to reach your goal? How much of a decline are you willing to accept? Burn that in your brain. So mine's 35%. So I can have up to 70% of my money in stocks. The other 30%, I'm either going to use money market CDs or fixed annuities because they guarantee principal. And we'll come back to that topic at a later date. But the other 70%, I'm putting in managed money accounts, one that I manage personally, and one that I've portfolios that I've picked from other money managers. And some of them include funds, mutual funds. So I don't think I have two accounts that are identical. And what's really funny is how different married couples can be. Sometimes one of them is a lot more aggressive, and as I say that, my mind's like whirring, and I'm going through, not worrying, whirring, like making a sound. And through all the years, and how many times couples are just not on the same page, financially. It's that is tough, sitting there in front of a couple, and they haven't really had the time to familiarize themselves with how financial markets actually operate, and not knowing that, you'll find out eventually, especially if you invest in things outside of CDs. But the earlier you find out, the better off you are. You won't be able to avoid volatility without reducing your returns pretty significantly. And in fact, a lot of people would have been way better off just to take the guaranteed return on a fixed annuity than they made. That would have made more money than what they made in their stock. And that is that's rough. You take way more risk, and then you get less returns, less in the way of returns. That's a tough place to be. And I know you don't want to be there. So if you hear anything that you'd like more information on, or you just want to talk, or if you're a client now and you're wondering, you've got questions, please feel free to reach out to me. I can't reach everybody all the time. I try. We call quite often. I put out a weekly newsletter. Actually, it's a bi-weekly. It goes every 2 weeks. And it's from my firm. It's got all of our contact info on there. There's a little letter that I edit before I send it. And so we try to stay as in touch as best we can. Occasionally emergencies come up, and that's to be expected. So I'll try to get to you as quickly as I possibly can. And anyway, this is the part of the service that we're doing, is sending out this newsletter that goes out every other week. And one of the other articles, and this came out actually in the Harvard Business Review on the 9th of May in 2025. In uncertain times, ask these questions before you make a decision. First question is, what decision today will still make sense a year from now? I really liked that one. I'm basically going through the articles that I like the best that I've sent out and saying, hey, you should probably look at that. So anyway, but I think that question is a solid question that would really help an awful lot of people making decisions. What decision today will still make sense a year from now? Big one. Number two, if a year from now this decision was used as an example of our leadership, what would it teach? Now, that one doesn't affect, or it's not actually related to a lot of household financial advice. So I think they were talking more about business. Anyway, what if this isn't the storm? What if it's the climate? What if the markets were to stay as volatile as they have been over the past 4 or 5 years? How about over the past 10 years? Well, it's something that you might have to get used to. And um, there's about 5 different paragraphs there that are talking about that, discussing that in detail. And quite frankly, they're doing a better job than I am. So, again, if you hear these things and you'd like them, just let me know. I'll put you on the list. Number 4, what's the cost of waiting? In a crisis, the instinct to pause, to wait for more data, for more certainty, for the fog to clear, can feel responsible and prudent. Leaders are taught to avoid rushing to reduce risk and to base decisions on evidence. In volatile environments, the pursuit of perfect clarity often conceals a hidden cost, the cost of inaction. I've seen that a ton of times. We used to call that the deer in the headlights syndrome. But anyway, so they give you very, I think, doable mechanisms you can use, mental mechanisms to try to help make those decisions. And again, those are the types of conversations that we have often and with an awful lot of our clients. And I have a ton of clients who I think are excellent decision makers. And it's just that when it comes to financial stuff, oftentimes you don't get 2 chances. Right? You don't have to hit home runs all the time. Occasionally you'll hit one anyway, but you're doing the right thing. And with just having a pretty good idea of how much risk am I really taking, what's that going to do to the long-term results of my investment portfolios? And you can't guarantee any of it, but you can make projections, highs, lows, somewhere in the middle. And I can tell you that somebody that's got 100% of their money in fixed income is probably going to have to be very frugal when they get into their retirement year. Somebody who has taken some risk and has resigned themselves to knowing that, hey, if you want to make above average returns or returns that are above whatever you might make on treasuries, you're going to have to take some risk. And the risk is just fluctuation. The way that the economy is set up, it's not going to go down and stay down. That is never happening. It can happen for several years. That can eat into your retirement savings by a lot if you weren't prepared for that. You need to prepare for that. And how do you prepare for that? Well, I got 5 minutes left. We'll have to cover that one next week. But you need to try to prepare for time for market turmoil. If that's not a part of your plan, and a lot of the financial plans, I guess my biggest problem with a lot of the younger planners is that they're presenting things as if nothing's ever going to go wrong, and that is not a good way, because you're going to make your clients really upset with you by doing that. And so you got to figure in, okay, well, occasionally the market's going to go down a lot, and we're ready for it. This is what we'll do, or these are the types of funds you should be preparing for that up front. You don't wait until it happens to prepare for it. So that's to be prepared for up front. And that's one of the things I don't think I've actually emphasized enough with my own client base. Hey, look, when I put this together, I was thinking about the times that the market would go down a lot. When I built this model, when I constructed using the various types of funds we're using, they're not always the best performing funds, but in some market environments, they will do a whole lot better than the best performing long-term funds are doing. And I definitely don't have time to explain that, so I will have to wait until next week. But it's pretty fascinating. It gets a little bit boring after a while, And I've only got a few seconds here before I have to finish. So, again, if you want to set up a meeting to talk about this and go over it, my website's bullingtoncapital.com, 330-664-0700. And so funny, I get so used to talking. I'm so used to talking about this that I start to hesitate to make sure I'm still covering everything, which, of course, in 1 hour is possible anyway. But the main ideas are the ones that you really need to get. You know, if you get more than 80% of the stuff right on this, you're going to do incredibly well. But so with that being said, I guess I will let you run. This is Bill Bullington. I'm here every Saturday morning from noon on 1420. My website is bullingtoncapital.com. I'll look forward to talking with some of you in the future. Have a good weekend, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.